Well, the bull market ended with Fed rate hikes and inflation soaring at the beginning of this year. At one point, the U.S. stock market was down over 23% before recovering half of those losses through the summer rally. There are challenges, though, ahead. Virtually all of the losses in stocks have come by falling valuations. I haven't really looked at earnings all that closely. In fact, analysts seem to be behind the curve on the impact of a slowing economy on corporate profits. PE ratios came down as interest rates went up. If inflation doesn't moderate, there will be further downside on valuations. However, in our forecast, we think valuations should kind of stop falling around where they are right now. On the other hand, the problem becomes as you move closer and closer to recession, analysts' forecasts for 8% earnings growth in 2022 and again in 2023 seem pretty aggressive. Using a bit more modest earnings expectations and assuming that valuations are likely to stay at current levels, markets close to 4,000, 42, 4,300 seem to be reasonably valued. However, as the economy moves to a lower glide path and those earnings results surprise to the downside, there is risk of further downside in the stock market as well. Our valuation models globally show that the correction so far has actually made stocks, in many cases, move down to attractive levels. Europe, the United Kingdom, emerging markets are actually quite attractively valued, and much more attractively valued than they were only 6 months ago. The United States, just above fair value, has corrected much of its prior excesses. It sets up the chance that the opportunity for stocks as the outlook for the economy begins to clear for a new rally to take hold.